Hello and welcome to Japan Market Espresso. This is your daily professional briefing on the Japanese equity market, focused on facts first, interpretation second, and noise reduction always. Let's start with today's market snapshot. In Monday's session, Japanese equities moved lower as risk sentiment softened across global markets, setting a cautious tone at the start of the week. The Nikkei 225 declined as investors reduced exposure following last week's volatility, with selling pressure broad-based rather than concentrated in a single sector. Trading reflected a classic risk-off posture, influenced by overseas market weakness and heightened sensitivity to macro headlines. From a market structure perspective, today's move was less about domestic fundamentals deteriorating and more about positioning and external signals. With US markets closed overnight and European equities under pressure, Japanese stocks lacked a positive external lead, making the market more vulnerable to profit-taking and defensive rebalancing. Export-oriented names, which have benefited from currency dynamics in recent weeks, saw cautious selling, while domestic and defensive sectors showed relative resilience but did not provide enough support to stabilize the broader index. Currency markets remained an important backdrop. The yen traded in a range that kept investors alert but not panicked, reinforcing the sense that equity moves were driven more by sentiment than by a decisive macro shift. Importantly, there was no single shock headline that defined today's session. Instead, this was a market-adjusting exposure at the margin, reflecting uncertainty around global trade, policy direction, and upcoming macro events. Volume patterns suggested institutional investors were active in reducing risk, rather than initiating aggressive new positions. From a professional investor's standpoint, today's price action should be viewed as a positioning reset rather than a trend reversal. The market is still digesting multiple large narratives at once, including currency stability, policy expectations, and political uncertainty, and days like today often occur when clarity is temporarily lacking. The key takeaway from today's session is not the magnitude of the decline, but the message it sends about sentiment. Investors are cautious, selective, and unwilling to chase risk without confirmation. This snapshot sets the tone for the rest of the week, where markets will likely respond more to macro signals and cross-asset movements than to isolated company-level news. With that context established, the next step is to understand what is actually driving this caution and which factors deserve attention as the week unfolds. To understand what drove today's market moves, it's important to separate immediate triggers from underlying forces. The selling pressure seen in today's session was not the result of a single negative domestic development. Instead, it reflected a convergence of external risk signals and internal positioning dynamics. The most immediate factor was weakness in overseas markets. With US markets closed and European equities trading lower, Japanese investors were left without a positive global reference point. In this environment, uncertainty tends to dominate, and marginal sellers become more active. This is especially true at the start of the week, when investors reassess exposure after weekend developments and global headlines. Another important driver was sensitivity to global trade and geopolitical narratives. Renewed concerns around trade restrictions and policy unpredictability outside Japan weighed on sentiment, particularly for companies with significant overseas exposure. Even without concrete new measures announced, the market responded to the possibility of increased friction, highlighting how forward-looking and expectation-driven current positioning has become. Domestically, political and policy uncertainty continued to play a background role. While there were no definitive announcements today, ongoing discussion around political timing and future fiscal direction added to the cautious tone. Markets tend to discount uncertainty quickly, and in Japan's case, even the absence of clarity can be enough to reduce risk appetite. Currency dynamics also influenced behavior, though indirectly. The yen did not move aggressively, but its level remains high enough in investors' awareness to affect positioning in exporter-heavy indices. When currency volatility is perceived as a latent risk, equity investors often reduce exposure preemptively rather than reactively. From a flow perspective, today's action appeared consistent with institutional risk management rather than panic selling. There was little evidence of forced liquidation or disorderly moves. Instead, activity suggested portfolio adjustments, profit-taking in previously strong areas, and a shift toward a more neutral stance. This distinction matters. Markets driven by structural selling tend to exhibit different behavior than those driven by short-term risk recalibration. Finally, it's worth noting what did not drive today's moves. Corporate earnings, company-specific news, and valuation arguments played a minimal role. This reinforces the view that today's session was macro-led rather than micro-driven. For professional investors, this context is critical. It suggests that near-term market direction will remain sensitive to cross-asset signals, policy communication, and global risk sentiment, rather than to individual stock fundamentals alone. Understanding this helps avoid overreacting to single headlines and keeps focus on the variables that truly matter. With these drivers in mind, the next step is to identify which themes deserve attention going forward and how investors should frame their focus for the rest of the week. Turning now to the key market themes to watch for the remainder of the week, there are three areas that deserve consistent attention. These are not short-term trading signals, but frameworks that will help determine whether today's caution deepens or stabilizes. The first and most important theme remains currency dynamics. Even without sharp daily moves, the yen continues to act as a silent driver of equity positioning. Exporters, index-heavy names, and broader risk sentiment are all sensitive to shifts in currency expectations. What matters most is not incremental fluctuation, but direction and speed. A stable yen allows equity investors to refocus on fundamentals and capital flows. A sudden move, especially driven by policy language or intervention speculation, would likely override other considerations and reset positioning quickly. Monitoring currency behavior alongside equity futures provides an early signal of whether risk appetite is improving or deteriorating. The second theme is policy and political signaling. Japan's market does not require frequent policy action to move. It reacts to changes in expectations. Comments from policymakers, discussion around fiscal priorities, or shifts in political timing can influence sentiment even before concrete measures are announced. For investors, the task is not to interpret every headline literally, but to assess whether the overall tone is becoming more supportive or more restrictive. Markets tend to price direction before detail, and equity reactions often follow changes in narrative rather than confirmed outcomes. The third theme is capital allocation and flow behavior. While not always visible day to day, the underlying trend toward improved capital efficiency, shareholder returns, and balance sheet optimization remains an important support for Japanese equities. Announcements related to buybacks, dividends, or capital policy do not need to be dramatic to reinforce this theme. Consistency matters more than scale. As long as these signals continue to appear, they provide a stabilizing background even during periods of macro uncertainty. Importantly, these three themes should be viewed together rather than in isolation. Currency volatility can amplify policy concerns, while supportive capital flows can soften macro-driven sell-offs. For professional investors, the challenge this week is prioritization. Not every market move will carry equal informational value. The focus should remain on signals that affect positioning at a broader level. If currency conditions remain contained, policy narratives do not deteriorate, and capital flow themes stay intact, short-term weakness is more likely to represent consolidation than structural damage. This perspective allows investors to remain disciplined, avoid reactive decisions, and engage with the market based on process rather than emotion. With these themes clearly defined, daily market movements during the week can be evaluated more efficiently, filtering noise from information and maintaining focus on what truly matters. With those themes in mind, the final step is translating them into actionable takeaways for the days ahead. This is not about making aggressive calls or forcing trades, but about adjusting focus and decision-making processes. The first takeaway is prioritization. For the rest of the week, currency behavior should sit at the top of the monitoring list. Before reacting to equity headlines or sector moves, investors should check whether the yen is confirming or contradicting the equity signal. If equity weakness occurs without meaningful currency movement, it is more likely to be positioning related rather than a shift in fundamentals. The second takeaway is patience with policy-related noise. Markets will continue to speculate around political timing and policy direction, but not every comment warrants action. The key is consistency. If policy language gradually shifts in one direction across multiple sources, that matters. Isolated remarks do not. Maintaining this distinction helps avoid overtrading and reduces the risk of reacting to incomplete information. The third takeaway is to observe flow behavior rather than price alone. Price declines accompanied by controlled volumes, and orderly trading often indicate adjustment rather than stress. Conversely, sharp moves combined with currency volatility and cross-asset confirmation deserve more attention. Watching futures, currency pairs, and sector-level flows together provides a clearer picture than focusing on individual stocks. Another important point is what not to do. Avoid interpreting single-day moves as definitive signals. Japan's market, especially in macro-driven phases, often requires multiple sessions to reveal intent. Early reactions can be misleading, particularly at the start of the week when global positioning is still being established. Finally, remember that structural themes such as capital efficiency and shareholder returns do not disappear during short-term volatility. These factors operate on a different time horizon and can provide support even when sentiment weakens temporarily. Using this framework allows investors to stay engaged without becoming reactive. The goal for the week is not to predict every move, but to respond appropriately when key variables change. If currency conditions remain stable, policy narratives do not deteriorate, and flow signals stay orderly, maintaining a balanced stance is often more effective than forcing conviction. This approach supports consistency, discipline, and clarity in an environment where information is abundant but true signals are limited. That concludes today's Japan Market Espresso. Today's session was less about dramatic price action and more about understanding positioning, sentiment, and the signals that matter beneath the surface. As the week unfolds, keep the hierarchy clear. Currency first, policy expectations second, and capital flows in the background. When these elements align, markets tend to move with conviction. When they do not, patience often becomes the most effective strategy. The daily briefings will continue to focus on what actually changes from session to session, helping you separate noise from information and react with clarity rather than urgency. For detailed levels, context, and supporting data, you can find today's notes and charts in the newsletter linked in the show description. Thanks for listening, and I'll be back with the next briefing.